Let's now turn to the advisory and look at whether traditional lenders can be too restricted by policy settings. Anthony Roddy is joining us from MortgageWorks. Anthony, welcome. So,
Hi, Andrew.
no one likes
Good to see you
regulation, and so how's that affecting when you take a look at taking a mortgage, taking out a loan? What's the problem?
Well, look, this has been an area of lending that's been particularly frustrating for us and our clients in recent years. It's really common for us to see clients that have a really strong net asset position and overall customer profile that are very sophisticated, in most cases very successful in their own right, be turned down by a traditional lender, effectively because they don't fit into a very narrow and restrictive set of lending policies. But fortunately, in recent times, we have been seeing more and more examples of these types of borrowers getting their lending approved through credit policy exceptions, particularly top-tier lenders, and probably some of these niche lender policies are lesser known in the wider market.
So what is it exactly that's holding them back? Why they perhaps reluctant to lend?
It's typically around income restrictions. So quite often, the bank is looking to confirm two major things when they're assessing you for a home loan. The first one is your equity position, and the second one is your serviceability assessment. Now, where a lot of these highly sophisticated and asset-rich clients fall down is actually the income assessment. So to give you an example, we're seeing some of the big four private banks now lend to customers based purely on their net asset position in isolation. So, for example, a customer might come to us that has $10 million in net assets, which might include their residential property, their home, stock portfolio, superannuation, or maybe even cryptocurrency these days. But they've recently sold a business, or they're in between major roles, for example, so that they're not ticking the income box. Now, in previous years, we wouldn't have been able to help this client, which is very frustrating for the client. They can't understand that. But now we're seeing lenders take a very commercial approach and actually lend to these types of customers based purely on their net asset position, which is very helpful. Another common example we've seen, which is probably very, very recent in terms of policy adjustment, is where you see a customer that might be a director of a large number of entities, and some of them may be either fairly newly established, and they may not have up-to-date accounting records, or alternatively, they're fairly well dormant entities as part of a wider group. This one's particularly tricky from a timing perspective and also from the accountant or advisor's perspective, because in a lot of cases, the client's accountant isn't comfortable signing off on a letter confirming the commercial status of the entity, because either they haven't seen any information pertaining to the entity or they haven't finalised the annual accounting work. And as such, even though the customer's overall group is very, very strong and is performing very well, it's impossible for a lender to get comfortable around this type of borrower because they don't have full visibility. So the recent change that we've seen is lenders are now accepting a self-declaration from the customer. There's a couple of lenders doing this. So a customer can self-declare that those entities, without providing any other information, that those entities are meeting their ongoing commitments and don't have any liabilities to other financial institutions. So effectively, the bank is starting to recognise a sophisticated borrower and face value, and they're willing to take their word on the commercial viability of their new ventures, effectively. So this one's been a really good one for us to help out some of our more complex and sophisticated borrowers.
Well, I'd imagine falling interest rates would help, of course, Anthony. Is that also seeing perhaps some increased competition there among those lenders?
Definitely. So we're seeing more and more examples of, depending on the customer profile, specific customer profile, you could get told no from one major bank and get an emphatic yes from another major bank. So the banks are competing much less on pricing, but quite often on policy in this area, definitely. And look, I've really only flagged, a couple of the major examples there. There's a stack of other examples.
So perhaps is there an inclination there to avoid the large lenders and look for better deals among the smaller lenders?
Pardon me, Andrew? That line just dropped out there for a moment.
Is there perhaps a tendency then to avoid the larger lenders who have more restrictive lending policies and look at the smaller end?
There's always an option. However, typically when you go with a lender that has a broader set of policies to offer a client, it comes with a higher level of risk for that lender, and so they want a higher level of return. So it's just a typical risk return weighting. So the customer is paying more. So what we're often trying to do is find out where we can minimise a customer's interest rates and minimise their cost at an institution which is typically not taken on that greater level of risk, or not been willing to take on that greater level of risk. And that's where we're seeing some changes in recent times.